Good morning. Welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. And joining me at MarketSite is Evan Bauman. He's a portfolio manager over at ClearBridge Investments. Evan, thank you very much for joining me again.
Yeah, it's good to see you again.
Let's talk about 2018. That's
Sure.
what's on everyone's radar. But before we get to that, the market run-up that we've had has been pretty impressive for 2017. And it was kind of out there that the proposed tax plan was what was driving stocks.
Yep.
Well, that's almost on President Trump's desk, and stocks are moving higher. It's not just a sell the news kind of event.
Right.
Would you argue that this is really predicated on economic and fundamental improvement?
Yeah, I think it's a number of things. I think there's, as you said, it's been a pretty good year for the market. The S&P's up 20+%. Growth has done really well, but people are still very negative and very nervous about everything, or so it seems. There's not a lot of euphoria, not a lot of optimism, save maybe certain very limited parts of the market, and mostly related to technology. So I think if you look at companies, and we look at ourselves as business owners, we've owned a lot of the companies that we own for decades, not just years or months. A lot of companies are sitting on tons of cash. Now, a lot of that cash is overseas, but even in the US, companies have tremendous balance sheets right now. What the tax plan allows companies to do is actually start to budget, start to spend that cash. And I think the very encouraging thing for next year is, again, say very specific parts of the market. Market's pretty fairly valued. Companies are flush with cash, and they can actually start to put that cash to work, both in terms of capital spending, which has really been limited to date, and M&A activity. I think the likelihood for a consolidation in certain sectors, both driven by, again, knowing what the rules are, as opposed to a whole bunch of political noise, which seems to have been the norm for the last 12 months, and bringing some of the overseas cash back in sectors like healthcare and media. That could be a pretty powerful combination. Combine that with the fact that, again, the general public is still very nervous. Even some of the professional public is still very nervous, which tends to be a pretty good thing for stocks. When people are nervous or skeptical, the market rarely tops out. So valuations are pretty fair. Balance sheets are great. Companies can start spending that cash. Certain sectors, I would argue, are actually really undervalued relative to history. So I think what the tax plan, assuming it's a fait accompli, allows companies to do is finally start to invest, finally start to do activities such as paying bigger dividends, buying back stock, making acquisitions of faster growing businesses. And so I think the setup for 2018, again, with some crowded trades notwithstanding, the setup actually looks pretty good.
Where do you think we'll see some sector rotation into? You mentioned healthcare and media were a couple of them. Where do you think that money is going to be put to work? Well,
so what's interesting about this year is even though growth, quote unquote, growth did very well, it was really mostly, and again, even though the market broadened out a bit, it was the mega caps. It was technology, it was internet, it was really the biggest companies. If you look at our growth benchmark, it's the 5 big tech and internet names that really drove the returns, the outsized returns of the benchmark. And so you can argue the fundamentals there are good. I would argue that fundamentals are good other places as well. And so without new money coming in, I think, as you said, you could very well get a leadership change in the market. When you look at areas like biotech, which historically traded at 30 or 40 times earnings, and again, headline risk notwithstanding, today some of the big biotechs trade at 10 and 12 times earnings and actually have some really exciting breakthroughs occurring in the pipeline in terms of novel therapeutics for big unmet needs. Areas like media, other than Netflix, you could say that a lot of the big programming companies are trading at some of the cheapest valuation points they've ever traded at. Some of the big programmers trading at 6 or 7 times free cash flow. Energy is still a very unloved part of the market. I mean, you've had a real dislocation recently between oil prices, which have actually risen quietly up to near $60 a barrel in oil, and energy equities, which are still under pressure because of money flow, which continues to leave the group. And you could look across the well-funded E&P companies, some of the service companies even, where balance sheets are in great shape and fundamentals look pretty good, but the stock prices haven't yet reflected that. So I would argue that it's, even though, again, fundamentals clearly are long-term drivers of stock prices, near-term stock prices have followed where the money's gone. Money's really crowded into mega cap, it's crowded into passive vehicles. So you've had this sort of run-up in big mega cap tech and internet companies. But underlying that, you've actually left some sectors like media, healthcare, and energy at some historical, really interesting valuations.
Who would have thought biotech would have been a value play, right?
Well,
Well, to wrap up, let's look at what are some risk factors. And 2017 was historically low in terms of volatility. Do you think we might see an uptick in that for 18?
Yeah, I don't think the market has to. Again, you don't have any signs of a top, right? So you don't have euphoria, you don't have overvaluation. I would argue there are similarities, between now and the late 90s. Just in that, technology is, again, the dominant part of the benchmark. It's really driven returns, but a very different looking technology rally, right? It's not dot-coms. It's
Right.
big, well-funded, great companies. The question is, again, you definitely have some crowding in some of those areas. So I think the risk is you just get investors who are really feeling a lot of complacency in big caps, piling into passive at what I would argue could be exactly the wrong time. At the same time, where as active managers, you have a bunch of companies at 10, 12, 14 times earnings in the growth space. So I think that clearly volatility has been low. It's unsustainably low with the VIX near 9, but it doesn't mean the market itself has to have a major correction or even a bear market. What I think you could get, again, is, as we discussed earlier, just this real rotation, a real change in leadership. And I'm not sure that a lot of investors are prepared for that. I think the easy trade for the last 3 years, which is just own the market, for the next 2 or 3 years, I think the trade might be, or really the best place to be, is being company owners, business owners, high active share, companies which are undervalued, where the likelihood is either the stock market monetizes the value of the business, i.e. re-rates a sector like biotech back to normal valuation levels. You don't even have to go to the previous highs. Or companies just start to buy up some of these undervalued plays. So I think that's the biggest risk. You're probably overdue for just a normal kind of mid-single digits correction because we haven't had one. But I think the risk is just mispositioning, investors mispositioning their bets right now. Or active management, I think, is really undervalued in a lot of cases. And passive has had a great run, but I have a tough time seeing it repeat.
All right. Well, thank you very much for joining us
it's
at
my
MarketSite. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.